Hey there, community bankers. Welcome back to the Correspondent podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Caplinger, Marketing Specialist for ICBB. It's time for our quarterly market update, and between the movements of the Federal Reserve, the upcoming election, and upcoming regulatory changes, we have a lot to unpack. So without further ado, please welcome our CFO Eli Barber, Chief Lending Officer Brandon Feltner, and Scott Kimel from our partners at FNBB Capital Markets. Hey there, community bankers. I'm joined today by our CFO, Eli Barber, our Chief Lending Officer, Brandon Feltner, and Scott Kimel from our partner at FNBB Capital Markets. How are you all doing today?
Great.
Good.
Awesome. Well, thank you for joining us today for the Q3 market update. I know a lot's happened since our last episode, so I'm just going to get right into it. The Fed delivered on their promise of lowering interest rates, and I say it like that knowing it's reductive, but they did it more aggressively than was even expected, with Fed funds rates down to 4.75 to 5%, down from 5.25 at the high. So anyone who has anything to say, what opportunities do you think this represents for our community banks?
I think we're going to see an increase in loan demand and just overall movement in the market. There's going to be some payoffs with that, but there'll also be some new opportunities available just due to current projects just getting sold. And hopefully we'll have an opportunity to help our client banks with refinancing those larger multifamily and hospitality deals.
Yeah, I'm sure that's true on the loan side, and I know that there are many portfolio manager of many a bond portfolio at community banks across the country who are breathing a sigh of relief that these rates are going to start going down, and maybe their mark to market on their available for sale securities might start coming back north towards zero. But I'll let Scott talk more about that.
Yeah, we're obviously seeing some improvement in the unrealized losses that were just so onerous a year ago. Since May, and basically in the last little over a quarter, the 2 years down 136 basis points, and the 5 years down 111 basis points. So that's obviously making a big impact on valuations. The problem that we've had is that so many of those bonds were purchased at a time when 1%, 1.5% looked very attractive relative to 8 basis points in Fed funds, which both the Fed and the market were assuring us that we were going to be here for probably 3 years. That you're seeing the valuations drive back towards zero. But nobody should be under the assumption that these bonds are going to ever get back in the black. We've got two things that are helping us right now. One is the fact that the rates are coming down, and the second thing is time. And I just assure everybody that everything will mature at par. It's just a matter of letting these things basically wither and get off the books. The one thing that's been interesting is in doing some analysis on portfolios of late, is that banks that were fortunate enough to be able to start to put some securities in the portfolio over the past 8 months to a year are now seeing something that we haven't seen, in half a decade. And those are unrealized gains in the portfolio on instruments that were purchased that had some sort of structure or that were non-callable, that allow these things to remain on the books even though rates start falling.
Yeah. Do you think, even though, you made a great point that a lot of these positions are so far underwater, they're never going to get back to neutral. But do you think with the decreases in rates that we've seen over the past few months, I know one of the challenges, along with dealing with these AOCI marks against portfolio, liquidity has been an issue for a lot of the banks. Do you feel like we're getting to the point now where I guess the losses at least comparable to where they, I mean, compared to where they were, a year ago, do you think bankers would be more likely to sell some of these positions and take some losses if they can redeploy funds and into lending or other avenues, or do you think uh, they're in the mindset of it's not a real loss until you sell?
It's very hard to do still because of the shape of the yield curve. Um, that is much more feasible if the yield curve is very positively sloped and you can come out of some of this shorter stuff and redeploy those assets in longer assets that have a larger yield differential. The one thing that we're starting to analyze for banks now is if that in fact is going to happen, even with the reductions in rates and the recovery in some of these valuations, it really makes a lot of sense to start preparing to do that after the first of the year. When any realized losses now, you have time to make up in the market over the course of a year, and not, in the case where we are right now, over the case of a quarter. If you've got loan demand, then it makes perfect sense. But to go security for security is still very challenging.
Yeah, I get that. But I mean, the yield curve, it's extraordinarily steep right now compared to the last 20 years. I think the 2-year, 10-year spread is plus 15 basis points. I mean, that's
Yeah,
as good as we've done in a long time.
yeah. As we've always seen, typically the curve reassumes its shape by virtue of policy. And as the Fed continues, there's talk today that several of the speakers were talking, they have no aversion to another 50 basis points at the next meeting. You'll start to see the curve steepen. And again, that will probably, if that in fact happens, create more opportunities to, to readjust some of these positions.
Yeah.
Right. So is it too early to see how community banks are responding, or do you have some insight as to kind of where our community banks are in response to the dropping rates?
I think we actually started seeing some uptick just at the beginning of third quarter, just based on the projected lowering of rates. Now it's going to be interesting to see how that movement plays out over the course of the next 30 days and beyond through the end of the year, based upon projected more rate decreases by the end of the year. So
Brandon, do you feel like borrowers, a certain percentage of borrowers were sitting on the sidelines anticipating that the rate cuts were coming, and they thought, I'll see what rates look like in a few months and start the project then?
I do. I feel like that they heard it, and now that they saw it happen, they're getting their books out now to put the plan in place to build that large real estate investment project or purchase or sale. Now that it just makes sense. So I think we'll be seeing a lot more movement here in the next 30 to 60 days, and folks trying to close out deals by the end of the year.
Yeah, I think you might be right.
My question is, I know with the, residential mortgage market, a lot of the time when rates drop, you see an uptick in prices. You think that'll be the same for development projects and commercial property?
I think so, because now that cost of funds are going down, and it's going to cash flow much better, and better margins, and there's still a lot of loan demand and housing shortages out there still yet. So I think developers and just investors are capitalizing on the times that we're in. There's just a huge housing shortage nationwide, and through COVID, it's gotten worse just due to just not a lot of movement and building. And when you have that, it just creates more demand.
Yeah, for sure. So I think if we have any borrowers listening, it's something for them to keep in mind, or, community bankers, it might be a thing to kind of counsel your borrowers on, lest they try to, wait for further rate decreases to kind of weigh those pros and cons. So another thing coming down the pipeline is the CRA modernization that's going to be taking effect on January 1st. And we went through some of that in the last episode with Derek and Ballard Cassidy. But, just from, a lending and a financial perspective, what challenges do you foresee for community banks once that takes effect?
I'm aware of some of the concerns that Derek and Ballard have been discussing, and was able to tune into the FDIC kind of update that they did last month for the Kentucky and Ohio areas. And, I think this modernization is going to be a challenge for community banks, especially the banks, particularly in Kentucky that are in, more depressed areas where there's not as much opportunities for the type of lendings that qualify for CRA. And, some of those issues have been coming to the forefront already, particularly with some of the FDIC regulated institutions. But one of the things that, as it pertains particularly to ICBB and many of the banks in our loan participation network, is the 50% rule of making sure that you're doing your lending in your CRA assessment area. And I think banks need to make sure that they've got their assessment area established correctly to encompass the area that makes sense for you, but also to be tracking the loans that you originate that are outside that area, to make sure that you don't run afoul of the new rule or the existing rule for that matter. But lending outside of your market is something that I know our banks keep an eye on, but it's something that you might want to measure more closely as you're, wherever you are in your, 5-year CRA assessment.
Yeah, I can relate to that as well. Being a community banker, having come from working in a rural market, a lot of times it's just challenging to find those projects that classify under the CRA model, and in an area where there's not a lot of commercial loan demand, you put yourself, with even slimmer odds of meeting those goals. So I do feel like it will compress and challenge rural community banks more and more with this additional guidelines that they're passing to make projects eligible. So I definitely see it becoming more challenging for community banks to be able to do these deals and get the ratio that they need.
Yeah, and that was kind of the consensus that, we came to last episode too, is that the modernization would pose more of a challenge to rural banks, which I mean seems to be the way it goes. Anytime there's new regulation, it's the small banks and the rural banks that feel the brunt of it. So, do you see any ways that community banks can kind of adapt their strategies accordingly to stay in line?
I feel like really growth and expansion, continue to diversify and try to grow your footprint to get more in urban areas to where you see more of those CRA projects.
One thing that we do help banks with on our side is for banks that have a hard time getting CRA loans or CRA eligible assets on the books. We do have access where we can actually build CRA eligible mortgage-backed securities through the market. And really what's required of that is that, a bank will give us the census tracts or the zip codes or whatever criteria that they want to use. And then we have access to markets where folks will actually go out and aggregate those loans and build a Fannie or a Freddie or a Ginnie Mae mortgage-backed pool that consists of CRA eligible loans within that bank's footprint, and they will qualify as CRA.
That's an interesting tool.
Yeah, that's great to know. And I'll put your email in our show notes in case anyone needs to reach out to you about that, Scott, if you're okay with that. So we talked about the Fed, we talked about CRA. What are some other emerging risks that you see in the market, and what are some proactive steps that community banks can take to mitigate these risks, just in case that we've missed anything major?
Again, from my standpoint, I would encourage banks that are lucky enough right now to have some liquidity and the loan demand is still not robust enough where you feel compelled to put every penny in that part of on the balance sheet, to look at some securities that have real good structure, and have some call protection in them for two reasons. One is obviously to lock in some yield, but then the other is to avoid the classic community bank mistake that we keep chasing yield at times like this because it's so attractive, but at the same time we find ourselves in 3 months, if rates come down even further, having to reprice those assets because we traded off yield for structure, and now we're just chasing our tails because we're repricing things back as they fall. And to remind you, banks are very well aware that loans on the books right now will behave in very similar ways because as customers have become much more price sensitive. A lot of these luscious assets that we've put on the books over the past year or two will come in and refi either due to economic pressures on the borrower or competitive pressures from the bank down the street.
Yeah, and keeping in line with the liquidity theme, if you're listening, if you're a customer of ICBB, reach out to us. If you need a Fed funds line of credit, and I'm sure most of the people listening may already have a Fed funds line with us. And if you do, don't be shy about performing your annual testing. I know that regulators always like to see that that's been done, and we're here for you whenever you're ready to test that line. So don't be shy about it. We're here to help.
And I would echo what Eli said, regarding the Fed fund lines, but also for holding company lines of credit as well for liquidity purposes. We're starting to see more of an uptick in those and would love to invite each listener to inquire with us about potential opportunities and how we may be able to help you and your community bank with a holding company loan.
Yeah, thanks guys for that bit of information. So to close, I have one last question. And, just to wrap up, what's your outlook for the market in the next quarter? And if you haven't touched on it already, are there any key indicators or events that you're going to be watching closely?
I can't think of any event that's going to happen in the fourth quarter that would have a huge impact on markets at all. No, but seriously, I know everybody, I'm sure, is keeping an eye on the election, and there's a lot of people that are smarter than me who can weigh in on how that may or may not impact, the banking market. But I know that's one event that we're all keeping our eyes on for sure. That, along with the Fed's future path forward and their rate decisions, which hopefully will not carry too many surprises.
Well, it's interesting because in real time, as we're doing this, Chairman Powell is actually giving a speech in Nashville, and it's moving the markets quite a bit. Some of the headlines, if you will, the bullet points that he has said to this point, I'm watching it, like I said, in real time. He made the point that the Fed is not in a hurry to cut rates quickly. The Fed will move over time to a more neutral stance. GDP revisions remove some of the downside risk, and the central bank will maintain its focus on the totality of data. This is obviously moving the market a little bit right now. Stocks are getting hit pretty hard. I think the market had pretty much thought it was a foregone conclusion that they would do another 50 at the next meeting. And looking right now live at Fed funds futures, futures are now showing about a 36%, and they've got another 25% fully cooked in for the November 7th meeting, and now the likelihood of a 50 basis point cut is down to about 36% from 43% when we started this call just a few minutes ago. So that's kind of what's going on in real time.
Eli, when you first started talking, I fully did not clock the sarcasm. But yeah, makes sense. Maybe I just try to forget that there's an election coming up for my own, mental sanity. Well, thank you guys so much. I think your perspectives are going to come in really handy to our community bankers that are listening as they try to, stay on top of how the markets are moving and make strategic decisions accordingly. There's so much, happening any given quarter. I think having your perspectives as a guide will be really helpful.
Well, thank you, Matt. Anytime.
Yeah.
Who's available.
Thanks.
Thanks.
Thank you for listening to the Correspondent podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.